Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day, I am Nick. I'm going to go through the key developments in global markets first, and then a little bit of an outlook from MRB. And then a very interesting piece on asset price bubbles from MRB. They call it mania profiling and the different stages that we get in equity market bubbles. Doesn't just have to be equity markets. It can be tulips, it can be property, it can be gold, like we had in the late 70s, early 80s. And it looks like we're building into another bubble for AI. Starting off China, we did write about it that we're expecting a Politburo meeting, and that meeting would hint or announce more policy easing in order to shore up the slowing economy and stem the deflation risk. So that's happened. There's been a big lift in Chinese equity markets over the past week. The Politburo meeting made clear that more policy easing is on its way. They're promising to resolve local government debt, a step up in state investment, and adjustments to property policy. Next on the list, the Bank of Japan tweaked its monetary policy for the first time in a long time. They adjusted their yield curve control. They are now going to allow the 10-year bond yield to rise above the previous ceiling of 0.5%. They've got a new ceiling now of 1%. So that's quite a big adjustment. No big shock to the markets that had been anticipated. And interestingly enough, the Bank of Japan has increased its inflation forecast. So the core inflation, excluding fresh food, for the fiscal year that ends in March, the median forecast from the BOJ is increased from 1.8% to 2.5%. The bank noted signs of change have been seen in firms' wage and price setting behavior. So that's good for earnings growth, definitely good for the Nikkei index. And then the Federal Reserve rate hike, they increased the Fed funds rate by another 25 basis points, widely anticipated to a new range of 5.25% to 5.5%. But it really does seem that that is going to be the last rate hike. Fed Powell, the Fed chair, gave his strongest indication yet that they would pause the monetary tightening at this point so that they can wait and see the effect of all the monetary tightening to date. Moving on to the GDP, the second quarter US GDP, well, it was quite a solid figure, 2.4% annualized growth in second quarter GDP. At the same time, disinflationary pressures are beginning to build, with core PCE prices increasing at an annualized rate in the second quarter of 3.8%, down from 4.9% in the first quarter. So really quite good. It's a typical Goldilocks scenario: rising GDP, falling inflation. Where were the strong growth areas? Business investment growth accelerated to 7.7%. A surge in construction of high-tech manufacturing facilities generated a 9.7% increase in non-residential structures investment. So there's quite a lot of actual data backing up the enthusiasm for technology communication services spend. Mania profiling framework and outlook. I think it's extremely topical, interesting, and gives us some useful direction. Episodes are bred from excess liquidity, a structural theme, growing investor confidence in that theme, and an appropriate catalyst. Asset manias are relatively common in the post-World War II era. Asset bubbles are a common occurrence, making them important for investment strategy. There are four main ingredients. The first of all, liquidity. Bubbles are inflated on the back of a plentiful supply of cheap money. Excess liquidity ultimately ends up flowing into select assets. So where are we with global liquidity? Cross-border Capital does some incredible research on global liquidity cycles. They have told us that we have entered into a new global liquidity growth cycle, which will most likely peak in 2025. So that would support a new bubble over that time period. The second major ingredient is a strong theme. Manias also require a positive, long-term structural theme that can capture the imagination of investors and encourage them to invest heavily. That theme is generative AI. Although the initial fundamentals behind most asset manias are legitimate, the problem is that investors become too enthusiastic about the potential gains and overprice the assets. They over-extrapolate the theme. The third ingredient is a catalyst. There is typically a catalyst that triggers a stampede into an asset class. The catalyst was probably when Microsoft acquired ChatGPT in January. And feeding the outlook is falling bond yields, which is good for long duration stocks. The fourth ingredient, accessibility. Manias require widespread public participation. In general, asset bubbles encompass 6 distinct phases. The first phase, the bull run, which is probably where we are currently. Bubbles start as typical bull markets, an orderly period of price appreciation on the back of improving fundamentals. Phase 2, a pullback and an asymmetric beta, usually in response to an economic policy event and correction in overall risk assets. So possibly that could be in the second half of this year if we get a jump higher in bond yields, or on the other hand, a potential short-lived recession. However, the correction is typically muted by historical norms for the asset in question, and prices quickly bounce back to new highs when compared with other assets. The asset class in focus appears to offer a higher than usual beta on the upside and a lower than usual beta on the downside. We term this as the asymmetric beta phase of a mania. And that leads into phase 3, the parabolic upleg. The sense that the asset class in focus is less risky triggers rapid price appreciation. On average, this parabolic upleg leads to a doubling in prices over a 2-year period before the bubble reaches a peak. So the 2-year period could well be 2024, 2025, that would coincide with the liquidity cycle that is anticipated. And then we have phase 4, phase 5, phase 6, and those are all part of the bear market in that asset class. I don't think I need to dwell on that. That's probably some way off. Anyway, as long as the monetary authorities act in a timely fashion and do not fail in their reflationary efforts, the world becomes susceptible to more frequent and larger manic episodes. So that's all to do with liquidity expansion. So what do cross-capital economics believe? They say that the sky-high valuations of some touted winners from AI, is there anything we can learn from the dot-com era? Well, I think there is, but they've mentioned a couple of times that the valuations are not at that dot-com peak. Bubbles can take years to form before they burst. Indeed, we wouldn't be surprised if the US stock market performs strongly in 2024 and 2025 amid renewed enthusiasm about AI, after suffering a temporary knock later this year amid a shallow recession. So that view is shared by bank credit analysts of all the regional markets in the world. BCA have the US as an overweight. It's the only market that they have as an overweight. And Alpine Macro has a similar view to that. So I think it's informative, it's interesting, and certainly something that we have been taking heed of. Gielie, how are things looking on the local markets?
Hi, Nick. Thank you very much for your interesting summary. I really enjoyed it. On the local market, let me start with ABI. We still own ABI. They had an update recently, and it announced that the group revenue for the year to the end of June 2023, this year, was 15 billion rand, and that is up from 14 billion rand in the previous year. So that is up 7.8%, which I think is really very good if you compare it with the inflation rate. They're doing very well. There was even a comment for an analyst, and this analyst is FNB. They said ABI is trading on a forward PE of 11.6 times, which is below its average rating historically. And they continue to regard ABI as one of the highest quality companies in the food sector on the JSE, with strong brand power, reasonable debt levels, high cash flow generation, and strong management. It remains one of their preferred picks in the food sector. In Anglo, they announced that the value of the rough diamond sales for the beers in the sixth cycle of 2023 was provisionally down 10% from the fifth cycle. What is more worrying perhaps is that it is down 36% from the same cycle of the previous year. It is a big drop, and it is an indication that even luxury goods are suffering. Anglo released interim results for the 6 months to the end of June. The year ends at the end of December, but this is 6 months results. And the comments of analysts are that Anglo they rate it as a buy, and they reported that Anglo reports reasonable value on a forward PE of 9.9 times and a forward dividend yield of 4.2%. And the stock is one of the preferred mining companies. So we own two of the world's biggest miners, Anglos and Glencore. Glencore is also doing well. Then statistics. The M3 money supply for June, those figures came out this week. The money supply figures are up 11.15%. The previous month it was 10.3%. So overall the trend is up for money supply, and it is up for more than 50 years. It's a steady upward trend in that graph of the M3 money supply.